Time really snuck up on me here, Jason.
I was just trying to send text messages right now. I'm like,
I had so many plans right before we were going to go live. Like, for example, I forgot to turn the AC down, so I'm wearing this wonderful pirate sweater. I'm already dying of heat. My whole plan was to turn the AC on right before we went live. Got totally caught off guard. So here we go. Everyone, welcome to the Pirates of Finance. We are your hosts. That handsome, devilishly handsome man next to me is the one and the only Jason Buck. I'm his less attractive, but at least I'm younger co-host, Corey Hawkson. And this is the show where we talk about everything finance. We're going to talk about business, markets, macro. Probably not, honestly. Portfolios, crypto, whatever we feel like, business, anything. It is absolutely under no circumstances financial advice, though. Look, it's the year 2023 now. It's time to turn over a new leaf, start thinking for yourself and not from random strangers on the internet. So this, under no circumstances, is financial advice. Speak to a professional if you need to speak to someone. Jason, I want to start off, thinking about taking advice from strangers on the internet makes me think about just believing the unbelievable. And so I want to start off, I'm gonna totally mess up this stream from the get-go, but I want to share a picture, and I'll describe what this picture is for people who are just listening in.
I just like your confidence that you were going to share a screen too. Like,
yeah, that one, I got really nervous there. I'm not gonna lie. I thought exactly. I was gonna crash the whole thing. Well, here's what I'm sharing. This is from a good buddy of mine on Twitter, Econompic. He's got great data. I recommend everyone follow him. For those who are listening, let me describe what this picture is. What I have plotted here is the 2022 returns for a huge list of real estate funds. And then what I also have plotted, though only through November, is the 2022 return for the Blackstone Real Estate Income Trust. And one of these things is not like the other, because the majority of these funds are down over 20% in 2022. And the Blackstone fund through November is up 8%. Now, there was some news this week, Jason. I don't know if you caught this. In Q4, Blackstone started gating redemptions.
Right.
Got a little nervous about people trying to take their money out. Got a little squirrely because it turns out all this shit's illiquid. But what you had this week was that the University of California's endowment, which manages over $150 billion in assets, said it was going to make an investment in the Blackstone Real Estate Income Trust, or BREIT, at the current NAV, right? So they are taking the current NAV as gospel truth, and they're putting in, I believe it was $4 billion. But for that, Blackstone is promised a minimum annual return of 11.25% for 6 years. And is providing a $1 billion backstop if the fund does not achieve that target. So sort of weirdly, for all this cash is promising a return. It sort of feels like a bond in many ways, a minimum return at least. I guess if the assets do better, they'll do better. But I was talking to Tyler about this before the show, the man who makes this whole show run. And one of the things he was asking about was like the responsibility of like, who actually values this stuff? Right? Because the big sort of wink, wink, nod, nod among everyone right now is like, that can't be real. Like, there's no way they can be that good. This is clearly just the difference between liquid and illiquid markets. But the question becomes, who's the auditor here? Like, why is this not being repriced? So I guess the question to you is, do you believe the numbers? Right? University of California is accepting NAV at face value.
Oh, man. Isn't this basically like inelasticity hypothesis? I mean, why
don't you want to, smart guy, why don't you describe what that is?
Well, seeing how I can't even say hypothesis, I never knew I slurred so badly or couldn't pronounce words until we started doing podcasts. It's just what is the ratio between, dollar into movement with underlying fund or underlying NAV. There's a lot of hypothesis about there's an inelasticity even in S&P markets for, because of target date funds. And for every, dollar into target date funds, it might move the market up anywhere up to $5, depending on whose research you look at. Some say higher, some are up to like even 12 now, aren't they? I mean, you follow this even better or more closely than I do.
It's a dynamic target for sure.
But when I was trying to follow even what you were saying, you were like, they're promising 11% returns a year for 6 years with $1 billion backstop if they don't. Like, just none of this makes sense.
Yeah,
I mean,
the only way I can sort of make sense of it is it's not so much right. So Blackstone's pounding their chest, saying this is the University of California. Like, who can do better due diligence than $150 billion endowment, right? That should be able to audit this. So Blackstone's pounding their chest, saying, clearly our numbers must be good. I'm looking at it as going, well, even if the numbers aren't good, they're probably not good, correct today. They're probably off. Maybe they're high by 20 or 30% based on public marks. But after 6 years, like, do I think that will compound at 11.25% for 6 years? Like, for all a University of California might be looking at this as just going, we think their money good on the debt. Like, we're basically buying 11.25% with an upside kicker if they do better, and they're gonna pay us, and it's really just a liquidity payment, right? Blackstone wants to be able to meet redemptions. They need cash. They don't have cash, and so they're buying cash from the University of California.
But you said University of California is paying at the positive NAV value, not at a discounted NAV rate, right? To get to that 11%.
Well, no, they're buying in at that current NAV, but they, as a holder, are guaranteed 11.25% returns.
I see. Now I see it's much more, that debt play. What a turnaround, by the way. You're talking about like in Q4 when they started gating redemptions and everybody was like, here we go again. It's 2008 all over again. When you start trying to create liquid wrappers around illiquid products, we see these things break everywhere. And then to turn right around, like, just when I think you can't do it, you just go and do this.
That might be a hefty toll to pay. Yeah, I mean, I don't know if they're redeeming themselves. To me, this is like, aren't you kind of proving that you're illiquid? Like, you're having to pay 11.25%. Now, look, 5-year rates are pretty high. Arguably, they why not just borrow in the treasury market? Could have been another option, but they're borrowing money effectively to meet redemptions is the way it at least appears to me. By the way, I have no insight here. I could be 100% wrong. I probably am. That's a good assumption, right? Anyone listening, I'm wrong. But it feels like they're just buying liquidity.
It is pretty amazing. And then, so they're using they're carving off $1 billion of the $4 billion as the backstop.
Yeah, I believe that is right.
God, it's like just high yield bonds, right?
That's what it seems like.
I just love all this stuff. By the way, speaking of allegedly, University of California, they've allegedly done due diligence. I couldn't help, but you got to say how many endowments were invested in FTX.
Yes. Yeah. I mean, look, there's the perception of the thing, and then there's the reality of the thing. Due diligence is really hard, right? Yeah. And what you tend to find with large funds is less due diligence probably goes in than they should. A, because the due diligence gets more complex. B, you sort of go, someone probably did due diligence along the line, right? It couldn't be this big without someone having dug into this. The fact that it's big should be proof that it's legit. Right. It's the small funds you got to watch out for because they haven't been proven yet. And that's, if you can get to escape velocity as a big fund, Madoff, you can kind of go forever unless you get eventually caught.
Yeah, to your point, everybody assumes, and this has been going around for a while now, that A16Z or Sequoia is doing their due diligence. So everybody that has a smaller VC fund can just piggyback off of their due diligence. And then we found out, via the transcripts that they weren't doing any due diligence. They thought they found the next trillionaire.
I will tell you the rumors are flying in the crypto circles about funds who made private investments now being under investigation because they got these securities, well, not securities, they got tokens as part of their investment and then sold those tokens, in theory, having insider information. And they didn't necessarily have a lockup on those tokens. So they're all under investigation is the current rumor. I have yet to substantiate that rumor, but I've heard it from a couple decent sources. So we'll see how that plays out over the next year. I saw a great graph the other day that it was like how people think crypto will play out. And it was a line going up of Bitcoin price. And then it was like regulation happens and the price jumps. And it was like, in reality, what happens is the line going up, the line goes to zero. It stays at zero for a couple months and then regulation happens. You know, it's like regulation tends to lag the chaos, not lead it.
But you're not surprised about, like, you know, when we saw like these VCs basically just washing shit coins and getting their money back out immediately. Like, you just knew this was eventually going to come to a head.
Yeah, I mean, I think we talked about this
Years
in the
ago.
past. I mean, I was having conversations with folks who were investing in white papers at valuations of $400 million for these theoretical crypto protocols. And I was like, how can you justify that? And they basically said, because you never expect to earn the money back on the equity. You're buying into the equity, immediately marking the equity down, but you're getting these tokens that you plan on just dumping. And you think that the way the cycle is, the tokens are going to get pumped up enough that you get more than your initial money back. And by the way, the typical VC cycle of 5-7 years, no, this is now happening in 6 to 12 months. And so there's a huge premium to pay for that initial liquidity.
Did you also see in other crypto news with Celsius that like the judge ruled that they're not a bank? I mean, obviously, but this week, I mean, obviously, I have friends that lost money in Celsius and everything, so I feel bad for anybody that lost money in it. But like the sweet irony was, Mashinsky used to always wear their shirts like "banks aren't your friends" and everything, and obviously they clearly were not the modern equivalent of a bank, because nobody has any recourse for getting any of their cash back out of Celsius.
Yeah, so explain that for people who haven't been following, because I think this is a big deal and potentially has implications for the FTX situation as well.
Yeah, because there's a circular nature to both Celsius and FTX and who invested in who, and vice versa. But essentially, basically, you know, creditors, you know, as Celsius has declared bankruptcy, essentially, the creditors, you know, or anybody had cash on their books at Celsius is trying to get their cash back out. But a judge just ruled the other day that this is not, obviously not FDI insured. It's not a bank. There's nothing you can do. This was just an investment company, and too bad, so sad, you lost everything. And then, like I was saying, the sweet irony was Mashinsky used to go around in a very douchey manner and just like shit on banks all the time and say banks aren't your friends and everything. And well, it's clear it's like he's thought he was building the modern bank, and that's what he's telling everybody. Clearly,
yeah, the deposits don't belong to the depositor. The deposits belong to the company. And therefore, whatever deposits are left are now going to be used as assets to pay creditors in proportion to how much they're owed, versus saying, oh, no, the depositors get paid back first. So
Thank you. You said it so much better than I could with it.
yeah. And it has, right? If you put $100,000 in and you think, well, I should get my $100,000 back first as a depositor. No, that is now treated as an asset of the company on their balance sheet and will be used to pay creditors. More likely to pay lawyers going through the bankruptcy proceedings. That's where all the money will go, unfortunately. But so I want to return to something though, because Tyler asked me, okay, what is the role of auditors in all this illiquid nonsense? And I pointed out to him, it's not just the illiquid stuff where this comes up. Even liquid, let me use air quotes here for those just listening, liquid mutual funds and ETFs have this issue as well when you're talking about more esoteric derivatives. So post 2020, one of the big examples was a fund called Infinity Q, where they were ostensibly trading variance swaps and also correlation swaps, corridor variance swaps, all of which is non-trivial to price, right? It might not price for days. These things might not trade. They're completely OTC. And so the question is, how do you put that in a mutual fund that's supposed to strike daily NAV? Well, there is someone who is responsible for determining the price. And then in theory, auditors are supposed to come in and confirm NAV every once in a while. Now, this was a case of fraud where the PM was actually falsifying what the prices were and then falsifying the documents that he was providing to auditors so that they would come up with the same numbers he was coming up with, or at least close enough that it would pass by the audit. I think it's insane that you're asking the person you're doing an audit on for the contracts. You think you would go to the counterparty to get the contracts, but such is the world we live in. And subsequently, the SEC has actually come out with new rules around some of these pricing requirements. But it's a tough situation, right? You go back to the Blackstone REIT and you say, You're an auditor and you're supposed to be coming up with these prices. If you come up with prices Blackstone doesn't like, they're going to fire you and hire another auditor. But you can't be so wrong that it creates a liability, right? That you're lying to investors. I don't know. Where's the wiggle room here?
No, I mean, like you're saying, it's the same shit, different day. Even in the comments, like Sean asked if I ever finished reading The Match King, and I did, and because it was about like this kind of thing going on in the 1920s and 1930s, right? And it's like you just said, MBS in 2008, right? Like, mortgage-backed, securities is like, where were the auditors, right? Asleep at the wheel, because also it's a circular nature, right? They want more business, so then they give the investment banks what they want. Everybody twists a few arms because people are people, and then people at the auditing firms want to go work for their investment banks eventually. But like you said, if it's not a tier one asset class or not traded on a listed exchange, you and I've seen some pretty scary stuff, especially if we go way out into crypto, where auditors or even like third-party administrators are just taking like screenshots at certain times a day. Like, it's just really scary once you get off a listed exchange traded instruments.
Yeah. How do you strike NAV for a fund that's investing in some DeFi protocol in a side chain, right? And they've got LP positions in these pools. I mean, it's not going to be automated. This stuff's popping up so fast. So yeah, you hear people using screenshots to strike NAV.
And Match King, by the way, is about like in the 1920s, he was building, an international conglomerate match empire, but his auditors, his, accountants, everybody was just taking his word for everything, because they wanted the business, and and they were fighting for different business, like they're fighting the other auditing firm. Everybody's fighting the accounting firm. Everybody's just trying to get more business. And so they bend over backwards for the people that are producing the commissions.
Yeah. I mean, my personal story, having been party to some situations of fraud in the past, right? My firsthand experience is people tend to become wildly distrusting after experiencing fraud of everything. And then you also tend to get like a huge amount of change in not necessarily regulation, but like oversight. So in my part of the investment world, I had a client who committed some marketing fraud. And what happened afterwards is all of these due diligence questionnaires started changing to try to very specifically dig out that type of fraud.
Yeah.
But what I thought was kind of funny about it was like, again, it's doing due diligence looking in the rearview mirror. It's like the next fraud isn't going to look like that. And so all you're doing is adding to the due diligence and regulatory burden and cost without really addressing the fundamental problem. And I don't know, it's a tough one. Like I at least for me, I feel like I developed a healthy skepticism, but I was able to understand that you have to operate generally with like a trust but confirm mentality in the world, or you'll never get anything done.
I mean, this is why, I love, listed markets and SMAs and everything liquid, and you can see the trading in real time, all of those sorts of things, and that way you can avoid a lot of these scenarios, hopefully. But part of it is like even, and by the way, like you said, they're just fighting the last battle, right? And it just keeps piling onto the regulatory burden, but you're doing things that have worked in the past, and whoever's going to commit a fraud, right, is going to be creative enough to do something that didn't happen in the past. It'll be a new form of fraud, and then we'll fight that last battle, and we'll deal with the more regulatory burden. But one thing Sean said in the comments is like that FTX had Armanino, which is like isn't some small unknown auditing firm, and so that's fine. But like same thing with like Madoff, right? He had that small accounting firm like run by his brother-in-law or whatever out of a strip mall. But like remember like Enron, right? Big Four accounting firms. What my favorite is like the Big Four accounting firms are constantly changing their name because they're constantly getting caught with their pants down in these sort of scenarios, and then they like just change their name and like, no, it's all good now. We're gonna go back to like running above board. But like, as they're just trying to get those commissions. If it's tens of millions of dollars a year in auditing or accounting or, regulatory like compliance, these things just always are going to happen essentially. I don't know if there's any way.
There's a fundamental conflict there. And I don't know how you ever overcome that conflict, right? It's a tough one.
Okay, I hope you haven't seen this. Maybe you have already this week. Speaking of this week's news, do you know how much Citadel made in 2022 revenue?
I haven't seen this.
Oh, that's good. I'll help you out. They manage about 60 billion in AUM across everything.
And this is P&L, like dollar P&L?
Yeah, rev.
When did they manage 60 billion entering 2022 or exiting 2022?
That's a good question. I just saw the headline, but it might have been. Let's just say it was. Let's say it was beginning.
I don't even want to know. It's got to be an absurd number.
$28 billion.
That, you know what, that I believe it, because I've got a buddy who's very senior there who seemed to be flashing some money around Christmas. So it's he must have gotten a nice bonus. That's how I should have backed out this number. How ridiculous was the suit he was wearing at the Christmas party that he just blew money on? Yeah.
But what amazes me about that, like you're saying, like you're not surprised, but at the same time, I'm kind of surprised in the sense that, as you know, as AUM grows higher and higher, it gets you become basically market beta, right? There's harder and harder places to put this stuff, and so like Phineas on Fin AI US on YouTube puts out these great videos, and one of the ones his most recent one was on Buffett. And it was another great video, but like, Buffett, his first years he was putting up like 100% returns, right? And he's always said if he ran a much smaller AUM, he would put up like sillier numbers. And so it's easier, right, to put up crazy numbers. You have small AUM, but you start running, large numbers. I mean, 60 billion in context, right, to BlackRock, Blackstone, is not that much, but it's still impressive.
Well, and I would have to, and I don't have any idea here. I would have to get a bet. Bye. You just leaving? You're just exiting the show? I'd have to get a better
the sun came
idea.
in, so I was like,
yeah, I'd have to get a better idea of how that money is split up, right? Like how much money is cash in support of market making operations that's just sitting on the balance sheet, for example. Like I know they do a ton of high frequency options market making, and that market has exploded in popularity since 2020, right? And so how much cash do they just have sitting on the balance sheet in support of that inventory versus actually allocated towards other pod shop style trades? So getting an understanding, like, right, what Buffett's doing, which is buying stocks and then selling them, is very different than what a Millennium does or what a Citadel does. In related news, though, one of the things caught me off guard this week. I got an inbound DM from a senior person at a large firm like a Citadel. I'm going to keep this as anonymous as possible. Talking about they were continuing to build out their crypto desk. That they were still like full steam ahead building out their crypto quant desk, and they were looking to hire people and wondering if I knew anyone in the space for senior PM researcher roles. And I was like, wow, I'm amazed that the reinvestment is still being done in that space, given how dead the liquidity is. So the belief must be it will come back eventually for these firms to continue building out these desks.
Do you think that's... I always wonder about like things like this. Is it because they're just large cargo ships, right? And they've been wanting to build this out for years, and it takes years of approval. And now that they've got it running, they build out the team and they have all the salaries in place. Like it's just inevitable that it's going. Like, I mean, how much do you carve out? Like this is an implicit bet, and they're really to continue to do it versus like they just can't help themselves. By the way, could our white balance get any worse right now? If for those watching the video,
what do you mean hour?
Man, this is so bad.
This ain't me. I'm in a dark room.
I know, that's what I'm saying. You're the delta between the two of us is insane. Like you're in a dark room and I'm just like lit up like a ghost.
Yeah, I don't know. I agree on the big ships are hard to turn quickly. I do think when you're talking about starting a new desk, though, like that can be shut. Like it's not like the desk is running. This is like they are starting a new desk to do this activity.
They say, okay, gotcha. So yeah, they just
and that could to me, that's like, you think this space will be interesting enough. Now, on the other hand, this is a large enough firm that perhaps it makes sense to make the small bet and the small investment right now if things do come back, because it could be so profitable, versus they can just shut it down in a year and write off the salaries and the research.
Yeah, but to your point, I've heard similar rumors that most of the investment banks or larger firms are continuing on with their crypto trading desks and everything. It's more like the smaller firms and the crypto specific firms that are shutting down.
And what's interesting here is it might be the opportunity for the larger firms to enter, right? Because you're seeing all the crypto native firms blow up. And so for people who want to enter the space, you might need a name like Goldman or JP Morgan, right? All of a sudden, like this is something I actually saw, again, very firsthand in the world of ETF strategists back in the 2013, when originally coming out of 2008, these ETF strategies, firms who built strategies using ETFs, it was all boutiques that were the biggest players. there was Good Harbor, there was F Squared, there was Alta, there was all these names that I'm sure no one listening now has ever heard of.
Yeah.
And one by one, they all sort of blew up either performance-wise or from a regulatory perspective. And there was probably somewhere in the realm of 50 to call it 25 to 50 billion dollars that was up for grabs. And the people who grabbed it was not the other boutiques. It was State Street. It was Blackrock. And the big institutions who said, we're not going to come compete with you because you're using our ETFs, suddenly in 2013 came out with all their own models and swept all the assets away from the boutiques. And the boutiques haven't been able to get a foothold since. And I think that's part of the cycle is like innovation happens with small firms, takes the big firms a while. But if you do get that sort of confidence blow up that the small firms can handle this, or in this case, the crypto native firms can handle it, the Silvergates, the Genesises, then what happens? Well, people who still want to play really want to only deal with tier one counterparties.
Yeah, I think you're definitely right in that sense. Everything always gets taken over by the tier one counterparties eventually, right? They're just biding their time. I also wonder, we're talking about Citadel's income. By the way, just the Citadel security side did, I think, $7 billion last year, just on the like the market making security side. And then I'm dying to see if anybody can ever find it, what Jump's income was, and to pair that up with the Alameda and FTX losses. And just see that it was basically Jump picking that pocket the entire
but I think I'm pretty sure one of the bridges across exchanges got hacked last year, and Jump had to pony up like $400 million.
Right, and they were like, no problem, because they made like $4 billion off of trading that. Like,
yeah.
But what's that bridge for? That was a Solana bridge, right? If I remember correctly, or no?
I don't remember. There's been so many hacks in crypto. I honestly can't keep track anymore. It's like, oh, that hack that happened 2 months ago, that feels like it was 5 years ago.
So my white balance got better for a second, then the sun came back out. And by the way, this is I'll change topics for us. This has been fascinating to find out, and it's finally coming around. It's like I'm in downtown Philly, and I just happen to be like looking at apartments and stuff here. And I've talked to maybe 3 or 4 different firms now that this is so great. Like they basically, you can come in and just get like fully furnished apartments, bring your toothbrush. It's like finally things are adapting to like modern life, right? Like crazy amenity floors with private, like private offices and everything for you to like work from home. And then like, if you're not in your unit, you can go down and use the extra space, gyms, amenities, like doormen 24/7, cold storage, lockers. Like, it's about time. Like these cities are catching up to like modern life.
Yeah, but isn't this the big argument against what's happening in modern America today of individuals no longer being able to find housing supply, because that sort of housing supply is getting bought up by corporations who are doing exactly that you can only rent anymore, and the housing supply is getting so constrained. That's why prices are inflating.
Well,
that's one argument at least.
You're saying like that, the argument that like you'll own nothing and love it or whatever, and that's why like boomers like to make fun of Gen Z about that.
Yeah. I mean, like, basically,
I don't have a problem with it, by the way. I don't.
Listen, as someone who spent the last 2 years basically living out of a suitcase and now has spent the last several months trying to furnish a house, I really enjoyed living out of a suitcase. I don't know why I need all this crap in my life, but when you have a house, you kind of need to buy all the crap, or else you're sitting on the floor. So yeah, I mean, I see the allure of the rental lifestyle. To me, it's like there's no arbitrage there in theory. You're paying up for the option.
Yeah.
But it comes at the question of like, you're now having all this property being managed and acquired by large corporations, right? Corporations continue to buy up all the residential real estate. Is that a net good thing in the long run for the economy to have everyone be a renter and not an owner? When you think of the American dream and using the house as sort of the white picket fence house and 2.5 kids and a dog.
But that changed in our lifetime. I mean, not to place blame on the boomers again, but as soon as you thought that you could flip houses to like make money.
Tyler with the great quote, "You will own nothing and you will be happy." World Economic Forum.
Right. They were like making fun of that. Right. That's how Ray keeps quoting. And But they, when the boomers started flipping houses, like we lost that ability, like you're saying, where your house was your castle or your cave or your home. And we could look at like hundreds of years of housing data, totally gone. We financialized these markets, right? That's just why in 2008 it blew up, because we had MBS and all the things we were talking about, just a few minutes ago. But that's what I'm saying, like that, to me, that ship has sailed. That idea that like your home has a separate value and you mark to model and all that stuff, that's completely gone. We've financialized this entire sector. So I think I'm just being more accepting of that.
Yeah,
Of
but
state of play.
doesn't the risk, just to play devil's advocate, isn't the risk lower? I'm going to use quotes here because you also know I like to say risk can't be destroyed, only transformed. Isn't the risk lower when the real estate is in a diversified set of hands versus several large corporations owning the majority of that real estate? Like if something happens to those corporations, you end up with this massive liquidation issue.
Oh yeah, you've dramatically increased the risk. It's a correlation issue. Yeah, absolutely. But I'm saying like this happened 20 years ago. We either accept it or we don't, right? Like that's like the people that are like just waking up to it now. Like this has been going on for like 20 years. There's been high correlation issues with just corporations owning everything. Also like financializing even the mortgage, side of the business. It's like there is no such thing as a diversified housing stock and individual ownership. I think that was gone 20 years ago.
I will say one of my favorite trends to come out of the last 2 years was the number of people who think BlackRock owns everything. Like, have you seen all those TikToks?
Yeah.
That are like, BlackRock owns everything. Vanguard owns everything. And it's like, well, that's not really how it works, right? Their ETFs and mutual funds own the vast majority of shares, which are then in part owned by individuals and pensions on your behalf. But yeah, you do have the corporate concentration risk to a certain degree. And I don't think it should be overlooked. All right. To your point, you said it's a correlation issue. It's a tail correlation issue, really.
Yeah.
It's not a correlate. It's not a problem until it's really a big fucking problem.
And I don't think we saw we saw hints of it in 2008. That's not the true tail risk here. Like you're saying, it's just building and building on itself. But at the same time, I'll kind of pivot it a little bit. I'm curious, like how you think about it. Like we're talking about like furnishing and everything. I think people dramatically undervalue how much it costs to furnish a house. Even whether you own or you're leasing, and they don't factor that into their cost structure. Like I also turn of the year kind of stuff. I was reading Bill Perkins' new book, like Die with Zero. I don't think we've talked about that on here. And in Bill Perkins' book, he always, he recommends, and you actually love it. It's about almost like staging the way you consume based on your life cycle. Like what's going to be important to you in your 30s, 40s, 50s, and 60s, and kind of figuring out your consumption versus your savings and relative value there, especially based on your mobility. Like it's never made sense to me. Everybody's like, well, I'm going to work my dick off until I'm 70 years old. Then I'm going to travel the world. I'm like, what, in a wheelchair on a cruise ship? Like, what are you talking about? And so he talks about a lot of that stuff, but then he always is referencing the old book, I think it's like 2 decades old, like Your Money or Your Life. And I was listening to some of that again, and it was like, it reminded me of, she asked the question in there, is like, okay, if you didn't do your job now, how much of what you spend in your consumption is based on your work now? Like, do you have to wear a uniform or like a suits to work? Are you commuting to work? Do you need that car? How much, like all of these things that I don't think people really factor in when they're thinking about budgeting. And I'm bringing this all the way around to like furnishing. So like, for example, like the places I'm in or places I've been looking at today and everything is like, if this TV has a problem, I just call the front desk. Like, and people don't ever factor that in. Like, as you know, people that like flip house, move houses, they're like, I made 46% on this house. And I'm like, did you really? Let's do the math on that. And you figure out like, it's like fishing stories or golfing stories. Everybody lies about how much they make on their house because they don't know how to subtract all their costs.
Yeah. As someone who was a longtime homeowner, I owned a house, condo in Boston from 2011 through 2019. And has been renting ever since. I see the dramatic pros and cons of both, though in both I have had to furnish. But to your point about the costs of home ownership, people dramatically underestimate the cost because you get the wear and tear that you put into the house that you really have to fix when you sell, right? So you have the value typically going up if you're buying in decent areas and holding for a long enough time period, you're just getting the market appreciation. But you're going to have to put money into the roof. You're probably going to have to deal with your boiler and appliances and wear and tear that you have to fix. So when I look at the number of, okay, here's what I bought, here's what I sold. By the way, now I have to pay, my agents when I'm selling, that nice spread there. And then I have to look at how much money I had to put into the place, not only at the end to rehab it, to make it more saleable, which maybe I got another, did I get all that money back? Maybe I got 50% of it back, 75% of it back. But then I look at all the things I had to fix over time. Like, it's not cheap. And furnishing is the worst. I got to tell you.
It's brutal. It's brutal.
It is brutal. My wife, when we moved into this place, I gave her a budget and she just laughed at me. And look, to my wife's credit, she's great at design. Clearly, this room was not designed by her. This is the one place she hasn't touched and it's just completely bare. But every other room, it's beautiful. But she also will spend $1,000 on plants. And if it was just me, right, I would have like a really expensive rower and a mattress on the floor, right? Like, I would just spend my money on totally different things. So we've got a whole furnished guest bedroom in this house that's got like multiple rugs and a really nice bed and all these, wonderful things that'll be superb for when when we have our kid and we have my in-laws or my parents come stay and help us out or whatever guests. You've slept there, right? It's a really nice room. Would I have spent any money on that room? No.
My favorite part too is like when I was at your house and everything. What this means for you is you're master of the cardboard. All you do is move boxes, unbox things, break down the cardboard, put it in the recycling, stuff it in your neighbor. I don't know about you, but I find myself on recycling day just going around the neighborhood at night trying to stuff cardboard into my neighbor's bins.
So embarrassed at the amount of cardboard that we've recycled. It is. I've had business calls where I've been looking out the window and I will see like FedEx come, Amazon come, USPS come, UPS come, DHL come, all within an hour and drop boxes off for stuff that we need for the house. It's absurd. It's absurd. But again, we got rid of everything when COVID hit and we moved out and we moved to the Caribbean. We got rid of almost all of our furnishings. We only had a 700 square foot apartment in LA anyway. We kept it pretty thin, but we got rid of everything. And so now we're moving into a, multi-thousand square foot house that needs to be furnished from nothing. Like, yeah, it's expensive. And I try to tell myself like we can carry some of this furniture on, but the reality is like that probably won't happen.
It's pretty house specific. I like your subtle flex there. Multi-thousand square foot house that we're living in. By the way, and Sean,
is that a flex? I don't know. You don't know the quality of this house.
There's tens of thousands of square feet. By the way, Sean Wineland in the comments said that if there was he said there's an app that you can use to track all your housing costs called Urbit. I think EURBIT.
Sean, I don't want to know. Why
exactly.
would you know?
I don't want to know.
No.
I was just about to bring something up that I would definitely talk to you about privately. So screw it. I'll talk about it publicly because I just don't know what we can and can't. We are obviously not tax professionals, but I was talking to a potential new tax guy. Then one of the things he brought up was that like mortgage interest is only deductible up to like $750,000 on a home now. Yeah. But he was saying if you have the wherewithal to buy the home cash and wait 90 days and then get a mortgage on the house, you could then use that mortgage deduction if you then use that money you pull back out to put into taxable investments. So you have to figure out what your delta would be, but it's very interesting. I don't know if that's true. I got to look into it, but I thought that one was fascinating, like talking about all these different unique strategies.
When I started my business, one of the things my father said to me was, you're going to have a lot of opportunities for tax dodging. You will sleep a lot better at night if you don't. Yeah. And he was telling me about stories back in like the early 90s where he had friends who would buy like rare books and immediately write them down. Like they'd buy a book and write it down for hundreds of thousands of dollars somehow. And that was like the play. That was what accountants were trying to get them to do. And my father's accountant was like, I promise you the IRS will be back to all of these people within 5 years.
Of course.
Just pay your taxes. Spend your time not on trying to minimize taxes. Spend your time on trying to maximize revenue. Profit.
Exactly.
Right? Please
tell me you have a pen in your hand that you're clicking and it's not your mic popcorning.
I swear if it's my mic popcorning, I'm going to lose it.
It is. So while you unplug it again, we got on a half hour early for Tyler and Corey to work on figuring out the solution to his microphone popcorning. And obviously we still have no effing clue of what's going on. By the way, I'm with you. The whole tax stuff makes me so nervous. I think just pay your taxes. But I don't think I think if you listen to what I said though, it's like you're then using that money in a taxable, you have to use it in taxable investments and everything. I don't think that one's like really skirting the line. The other one that I think that's interesting right now is that you have to get the real estate depreciation against your active income, you have to be a real estate pro, which is like 750 hours a year. And right now, if you're doing short-term STR, short-term rentals, like with Airbnbs, you only need 100 hours to qualify. But there's no way to me that loophole doesn't close in the next few years, which is fine. People can take advantage of it, but using that and thinking that's going to be your plan long term, I think is kind of delusional. I mean, like, as these things pop up and go away so quickly, like, accelerated depreciation across, like you're saying, asset like rare books. I've seen people use, stallions for like accelerated depreciation. Even I saw somebody was trying to use Bitcoin miners and use the FF&E for accelerated depreciation to doing a cost seg analysis, cost segregation book like analysis on the commercial real estate, and saying their Bitcoin mining rigs were a cost segregation.
Yeah, I don't play any of those games. I do my tax loss harvesting where I can. Last year was a ton of bonds and crypto that I was able to tax loss harvest, which was phenomenal. I'll carry that forward. But other than that, like, there's the low hanging fruit, 529s and all that sort of stuff offered in the US that I think if you're willing to give up the liquidity, right, because you're planning for a very specific outcome, so 401ks or 529s, and you're willing to give up some of the optionality of how you want to use that cash,
yeah,
great, right? I think it's a huge advantage. I actually just learned, and again, not an accountant, talk to your accountants about this, learned recently via Twitter that you can open up a 529 in your spouse's name before you have kids, and then you can transfer that 529 to the kid. So let's say you get married and don't plan on having kids for 5 years, you could be contributing to a 529 in your spouse's name for several years before the kid is born. And then as soon as the kid's born, you can pass it as a direct descendant.
That's really interesting. So have you already started doing that, or you just learned that you can do that?
No, I just learned I could do it about 3 months before before I was having a kid. So it didn't really seem like it was worth the hassle. But for kid number 2, right? Like after I had this first kid, yeah, it makes sense.
I was just thinking about in the comment section, like we probably just making Sean Weiland's head explode when we're like, yeah, we just pay our taxes and don't worry about it. Sean's like, are you guys fucking kidding me? Like he's like all these things you could be doing. Like you said, if you like don't want direct access, there's all sorts of trusts you can do and everything like that, and you have tax deferral strategies. But let's call them deferral strategies, not avoidance strategies, and that's what you and I would definitely steer clear from. The other thing was in the comments at the beginning of the episode, everybody was like making bets on when you'd popcorn and everything too. So I'm sure there's the robust betting market.
Yeah, what was the line? I was gonna say, what was the line on popcorning? Exactly. What frustrates me so much is that I upgraded my mic firmware. Yeah, thank you, Bacon Memes. I believe in Corey's mic too. It just it works for Zoom. It works for everything I'm recording. I've decided it's definitely Firefox. I'm switching browsers next time. That's what we're going for. We'll figure it out eventually. You would think a bunch of guys who run podcasts would figure out how to deal with audio issues, but alas, this is the world we live in.
In other breaking news, I found out today that you have landed your biggest guest of all time to do a live podcast when you're in Miami in February. Is that true?
Look at you pumping yourself up. You got those pump shoes on? Those little what were those back in the day?
It's just like, yeah, so I'm searching for topics today, right?
Yeah, very excited to announce. So Jason and I are both going to be in Miami I'm originally going for the exchange ETF event, or ETF exchange. I don't know which direction that is. Feb 5th through the 8th. And Jason's going to be there as well. We then are going to another conference shortly thereafter together. But you're joining me for a live recording of Flirting with Models at the exchange event.
Dragging me into the ETF universe.
Yeah, kicking and screaming. I'm sure.
By the way, that will be 4 events back to back for me in Miami at the end of January, early Feb. We got to also let's make it 5. We got to figure out a Pirates meetup. And Sean was asking if your guest was going to be Nassim Taleb. And unfortunately, no. It's just little old me. But I should have said this to you the other day.
Can I tell a Taleb story? Not a story, real quick, but like people, like I'll say something on Twitter, and people will tag him Be like, Talib will have the answer. I'm like, nothing scares me more than that man knowing about my existence. I want to stay off his
Why?
radar as long as possible.
I remember years ago, like my partners and friends, like I even tagged him on something I said or something like that, and they were like, "Don't do that." And I was like, "I'm not scared. Like, why are you so scared of it?" But like at the same
He's
time,
a maniac.
yeah, true. The one I need to send you though is Universa is doing a boat cruise on like during one of the events and on like a yacht, and he's the guest speaker, obviously because of his connection with Universa. But I was like, it didn't seem very on brand, but
Seems very tail risky to me. You think that they would have like it on the safest point of land in the world? Like they'd find the one point of land that's like has the least probability of any sort of like flood, weather issue. That's where they build their chapel of risk.
Except for their firm is in Miami. I almost said which neighborhood, but like in Miami. So I mean, that gives you an idea. But like but I am shocked, like knowing some of the people at the firm and everything. It didn't seem very on brand for them to have a yacht, like you said, not only tail risky, but also pretty flashy for them and everything. But
so does that mean they had a good year last year or not a good year?
I don't know. It still hasn't been leaked. So usually when they have a good year, it's leaked, but
it's leaked immediately.
Yeah, and I'm not going to be the one to leak it. So
yeah, flashy events to retain your clients. That's normally how it goes. That's normally how it goes. I know I can tell who's having a good year and who's not having a good year based on their haircuts most of the time. Like you see the guys who are entering the end of the year and it's like they haven't cut their hair and their beard is shaggy and they're taking meetings in t-shirts. You're like, you're having a really good year because you couldn't care about me. Less. I'm not talking about you. I'm talking about I know a bunch of people that are like this versus the guys who are entering the year like suit and tied up. You're like, yeah, you've got some sort of performance issues.
And for me, it's going to be straight up onesie season. Most people prefer I call them jumpsuits, but I'll be wearing onesies.
I will be very upset if you're not wearing the onesie in Florida. Are you? By the way, are you going to what is it? iConnections the week before, which is like the massive hedge fund conference.
Yeah, we have MFA, iConnections. Context is going on. I don't think we're going to that. And then you have ETF exchange, and then we have that private, and then we have the private event after that. So,
well, talk to me. All right, so give me your opinion on conferences. Given that you're going to so many back to back, I assume you love them.
Well, too, I also want to shout out. We are having a Pirates offsite. And Tyler's coming down to Miami as well in early February. So we definitely need to figure out a meetup, and we'll put that on Tyler's shoulders to figure out the meetup. We'll figure out like some sort of type form or something as we put everything on his shoulders. Conferences, I can't stand them. And by the way, when I say we're going, is like I don't actually attend the events. I hang out adjacent to the events and have meetings, coffee, lunches, and dinners with managers and friends. And it just, for me, it's just convenient, right? My managers come in from all over the world to Miami at the end of January, early Feb. And so they're all in one place. So it's easier for me to, put together dinner so we can all hang out, just put, FaceTime, that sort of stuff. But yeah, I do not do the, I don't know how much you know about like iConnection, context, all that stuff. It's like, it's speed dating. It's 30-minute pitches, like just back to back to back. And I don't know how anybody gets anything done. Like you got to be just blind and, deaf, dumb, and drunk by the end of those. Like if you imagine if you had to do your pitch 10 times in a row.
Yeah, I've done those.
It's terrible. Like,
I
can imagine that.
Yeah, my thoughts here. So I've done this ETF exchange event and its predecessor event for probably a decade now. And I, like you, I don't think I go to any of the events. I don't go to the booth room. I don't understand that. I honestly cannot comprehend how anyone justifies the investment in these booths. The ROI has to be next to zero. It has to be just pure, like, I hate to say it. It's like, it's got to be a dick measuring contest for these firms to say, I'm BlackRock. I'm showing up with this big, massive booth. Everyone should know who I am. It's just,
is it a write-off? Is it a write-off? Like the booth construction?
But,
well, wasn't it last year that, sorry to interrupt you, but isn't it last year that Simplify had the hot sauce though?
Yeah, and those are all expensive,
that's smart.
Right?
That's smart, yeah. But the thing about your swag, you got to be smart about that game. And wasn't it ETF exchange last year where Meb had like the door hangers and everything? Like if you got some tail, they had
yes, yeah.
Meb is the most creative by far.
Which I thought was great, though he got some pushback on. Someone thought it was sexist for some reason, which I didn't get at all. He had these little outside the door. He had door hangers on everyone's hotel room that said tail, which is his tail risk hedging ETF. and someone thought it was like related to getting tail, you know, and turned it into some sort of sexist. I don't understand. First of all, if you're getting tail, it doesn't mean male, female, anywhere in between. Like whatever. This is a different conversation. Back to the one at hand, which is conferences. So I 100% agree. I go to this conference not to attend the events. I definitely don't go to the booths. I go because everyone else I know is going to be there, and I can get a tremendous number of meetings done in a 3-day event. Right?
Exactly.
I can meet with 50 people and all the providers, all advisors, everyone in the ecosystem that I need to talk to, get it all done in 3 days, and good for 6 months. Right? So incredibly efficient from that perspective. I've also done those events like the ones you mentioned that are speed dating, where over a 2-day period, you get matched with, call it 20 to 25 potential allocators, and you sit down for 15 to 20 minute blocks. And it's like, let's feel each other out. Do you like what I'm talking about? You know, like, do I like what you're talking about? Do we think there's a good mix? Great. It sounds insane, and it is exhausting.
I was going to say, how exhausted are you after these events?
You're dead tired. And you also like forget where you are because you've had the same conversation 40 times by the end.
Right? That's what I'm saying.
You're like a broken record. You go on, you're like, wait, did I already say this to you? Or was that the meeting 3 meetings ago?
Exactly.
And part of the problem becomes is there's also night events. You all go out to dinner and you sit down next to someone and you're like, I definitely have spoken to you, but it was 17 meetings ago and I don't remember anything about you. And you're both embarrassed about it because it's the same. But they are, again, it goes back to thinking through something you and I have talked about, the cost of client acquisition. So if I pay for this event and I go and I get 25 to 30 meetings, right, that all of these advisors are flying in, I have to think to myself, what would the cost for me be to get in front of 25 to 30 sort of pre-qualified leads and get 15 minutes, right? These are advisors from all over the country or allocators from all over the country. Typically, they are opting in to talk to you, which means they've at least pre-qualified whether they make these types of investments that you offer. So they're semi-warm. They're not dead cold. And it's their environment. They're coming to do due diligence. So you know it's people who are actually serious about what they're coming to listen to. And so I sit there and go, okay, how much am I paying to get in front of 30 advisors? How much would I have to pay otherwise to get in front of all these people? Would I ever get in front of them? For some of them, it's the only due diligence trip of the year they'll make. They won't meet with anyone otherwise. So I do think there is an argument for the ROI there.
Well, but you'd also have to be able to attribute the AUM, and that's very difficult to do. And it'd be interesting to look back on it. And I don't want to like shit on these conferences.
No, you can definitely, but you can attribute the AUM to say, like, especially in a mutual fund, you can track the advisors and know when they allocate and say, okay, how many, like, and you can back out very easily how much money do I actually need to come in to justify the cost, to overcome the cost, and then everything else is. But
that's what I'm saying. Have you actually ran that and you feel like you're net positive?
Yes.
Okay. By the way, shout out Brian Moriarty in the comments. He said something that reminded me of, this is a great question for you. Have you ever been to a Dungeons and Dragons convention?
A convention? No. What did Brian say?
Conference. No,
what did Brian say? I'm not reading the comments.
He said something about being in a D&D. He said we played D&D with one of them on Wednesday. I'm not sure it was in reference to what we were talking about, but it just reminded me of for those that don't know, Corey's heavy into D&D, and that's why I was just wondering if you've ever been to a D&D conference.
No, I've never been to a D&D conference. No conventions. We did do a weekend retreat with my group of D&D players recently. It was phenomenal.
A weekend retreat for D&D. That's what I'm saying. Maybe that's the conference we need to have, like FinTwit/D&D, and you get your crew together, and that's how you get to know the allocators. You guys play D&D together.
My wife loves to bust my balls about this. So not even like making fun of me. She loves it. But she's like, we play on Wednesday nights, and I'm like, I have to go play pretend with a bunch of grown men on Zoom. And she loves telling people about it because I don't tell anyone about it. I'm like, it's my own personal thing. Like I'm hanging out with the boys. We're collaborative storytelling. It's a good time. We're sharing some jokes. And my wife will meet someone for the first time. She'll be like, this is my husband. He plays Dungeons and Dragons. And I'm like, babe, what the fuck?
Unfortunately, I'm right there with Lauren on it. But like, let me step back though. We're probably just jealous. Like, we don't have a crew that we play make believe with, you know. And so maybe it's out of jealousy that Lauren and I are always, you know, busting your balls about it.
I'm just trying to stay young, man. That's all.
Does you think D&D keeps you young?
Absolutely. I'm just playing pretend imagination.
Sean Weiland's asking you, Warhammer 40K, yes or no?
I'm sure it's great. I've never gotten sucked into the Warhammer hole.
I have no idea what you guys are talking about.
See, well, this is rare for me that I know something about something you don't. Normally, you're in the teaching seat. This is great for me. I'll keep my little edge of nerdiness.
But I feel like, though, you say that, but I think that's only like privately. I'm always on this podcast. You're the one like teaching and everything. You're the one that is, you know, I just sit here and stumble through my words, but you know, privately we talk about a lot of other stuff that I got to figure out.
Wasn't it just a few episodes ago you were teaching me about the weird soccer rules in Germany?
Yeah, but you know,
so yeah, let's not talk about who knows what here. If we're measuring who knows more esoteric things, it's definitely you.
Okay, this is actually fair. What's weirder, you know, make believe in D&D or make believe in soccer? You know, the sport that everybody hates. You know, maybe I know way too about that, but it's a solo effort on my part.
I think soccer arguably is the sport most beloved across the entire world.
Well, yeah, except America. That's my point. Yeah.
Okay, so let's take a totally different direction. But staying on soccer, do you think if the United States were to take all of its best athletes and try to compete in soccer, would we dominate?
Yes. It was a Brazilian coach. I'm trying to remember which one. He said it perfectly. It was a few decades ago. He was like, if America ever got serious about soccer, they would dominate because they have the best athletes, best training facilities, the best everything in the world. And that's the whole point, is like what we don't realize.
How long would we have to make that investment?
At least a generation or two, probably. And we're getting closer and closer. What we're doing now is very different in the sense that like almost all the players are Germans, actually. So it's American servicemen like in Germany and the Netherlands and stuff like that stay and get married and raise a family there. And those kids have the U.S. citizenship. So they're actually born, raised, and trained as European players. So that's a little bit different. That's why the team seems to be getting better, especially on the younger side. But no, it's what people don't realize is the biggest issue, I think, is that in America, it's a middle-class sport, especially upper middle-class sport. And the rest of the world, it's a poor sport, like played in the streets with rags and tape. And people use that sport to, you know, to make their lives better. Where in America, we use basketball and football to make your lives better.
Right.
And so that is the primary issue, right? It's like, it's more about like getting paid. And if you can see it, you can be it. And, you know, like the MLS, they don't get paid in the US. So it's like every day on TV.
Why try to, yeah.
That's what I'm saying. So it's like the incentives aren't there. Like the incentives are not there. And yeah, like ours is this weird affectation of like the middle class and upper middle class for the most part.
Do you think we could, as a country, adopt another sport? Like, do you think soccer can become popular and still have baseball, football, basketball be as big as they are? Do you think you have to see sort of another one wane for soccer to wax?
It's hard because, like you said, how you get the best athletes, but there's different size issues, maybe like for the NFL and NBA versus soccer. But yeah, people try to make that argument before. I'm not sure if it works. It's not something, honestly, I'm terribly concerned about. Who cares if we suck at soccer? You know, just because the rest of the world loves it.
Oh, I don't care.
No,
Proudly,
but
fiercely independent. I don't care about any of these sports.
By the way, I'll tie it back in though to a little bit of our stuff and business and quant and all that stuff. Is, you know, John Henry that owns Fenway Sports is now selling Liverpool, and the rumors anywhere from like $4 to $6 billion to sell Liverpool. They bought it about 10 years ago, I want to say, for $450 million.
I feel like so many of these franchises got bought around 2008 as like fire sale liquidations and have 10x'd over the last decade. Both soccer franchises. You hear about basketball franchises, same thing happening. Not so much NFL. Those seem to have always sort of been a coveted crown jewel. But it feels like a couple of these like basketball, soccer franchises have flipped over in the last decade for big returns.
Yeah, well, the difference is you have you have relegation in European soccer, right? Like you can get relegated to a lower league. We don't have that for the NFL and NBA. That's how they maintain that franchise ability. And then the NFL, all those teams are now in the top 10 again in the Forbes list because they just signed a new TV deal through 2032, I believe, for tens of billions of dollars. So like it's all about then when are the TV deals structured, who's negotiating them, and then the other thing that European soccer, especially the English Premier League, doesn't have is like they've been trying to instill like financial fair play rules. It just doesn't work, and so therefore like most of the teams like lose money. Like Roman Abramovich allegedly before he was forced to sell Chelsea to Todd Bowley, he had come out of pocket like $2 billion over 10 years to build up Chelsea.
Really?
Yeah.
I would not have guessed that.
Yeah, so
given
like
how big a name Chelsea is.
Yeah, it's an affectation. It's not a money-making proposition. I think that obviously John Henry, being former CTA and all that stuff, I think they're really good at running businesses, obviously with Fenway Sports Group. And I think they ran Liverpool like a pretty tight ship.
Hold on. Did you just say former CTA, therefore really good at running businesses?
No, well, I mean,
connect those dots.
Okay.
For me. Connect those dots for me. I know we're over, and this might have to be the final thing we talk about. How does being a CTA make you good at running businesses?
Fair question. I don't appreciate your tone. But to me, in a sense that like it's pretty agnostic. Like when the Red Sox really took up the mantle of Moneyball from the Oakland A's, as you see, like, if you've read the books or watched the movie or anything like that, because John Henry is pretty unemotional agnostic about business, right? He just like a CTA would be a quant. It always weirds me out that people talk about CTAs as quants, but you could debate that if you want. But it's to me, it's much more thinking about the numbers and running a business in an unemotional way and trying to make the numbers work from a quantitative basis. And so, is that fair or no?
You can do pirouettes philosophically. That was really impressive. Very well done. And you said it with a straight face too.
Because for example, like if you don't want to lose your shirt in soccer, what you have to do is, God, now we're gonna have to get in. I know we're already over. Is like the player cards. Basically, the way it works is a player has what's called a player card, and the team starts buying their player card at like 13 years old. And then the team will invest millions of dollars into them because eventually they can sell that player in what's called a transfer fee, where they're selling a player card to another club. And they pay tens of millions or hundreds of millions of dollars in transfer fees. And then their salary is totally separate negotiation. So it's a totally different way of looking at sport. But the way you can do it then is you have to think about your youth system and about buying players on the cheap and flipping them on the deer. Right. And so somebody like John Henry and Fenway Sports, this is what they were really good at. They don't overpay for players as much as they bring players along. Maybe you buy that transfer fee at 10 million. You build them through your system for a few years, then you sell them for 40, 50 million to like a larger club. So the clubs like Paris Saint-Germain and those kind of clubs that are owned by, the United Arab Emirates, Abu Dhabi, all of those kind of firms, they will overpay like the Yankees. They'll spend hundreds of millions of dollars and they don't worry about their youth system. And so they don't mind losing money because this is a soft power play. So that's what I was saying about John Henry and the quant system and Moneyball, going back to CTAs, is there is a way to do this without losing your shirt, but you have to be really unemotional about it, and you have to sell off your best players from time to time.
I think that is the perfect place to end it, Jason. Well, everyone, appreciate you tuning in on a Friday afternoon. I, again, am very impressed with us that we continue to get this time right. Maybe eventually we'll fix the popcorning issues, and then we'll have the perfect podcast. But please don't forget, if you've enjoyed spending some time with us, like, subscribe, share with your friends. Check out the clips that we're posting on TikTok. I think we're sharing them on YouTube. They're out there on Twitter. We got Tyler trying to find the most interesting parts of the show, clipping them. So definitely check that out. With that, thank you to everyone. Have a wonderful weekend. And Tyler, let's roll the credits.